Hello, I'd like to talk to you today about a measure that is found in the latest Finance Act. The rules are set out in section 290 and largely schedule 37 of the Finance Act 2014. And it's to do with what are now known as employee ownership trusts. This came about as a result of a consultation that was launched not this year, but at the time of the budget last year, so back in March 2013. And following the consultation process, which a lot of people, probably not technically correctly, referred to as the John Lewis model, the Chancellor announced in his last autumn statement, just before Christmas 2013, that he was minded to introduce 3 new tax reliefs which he said were designed to promote what he called indirect employee ownership. You can see why it's called John Lewis, because of the famous department store where effectively every employee is effectively a partner and shares in the profits following the death of the founder of John Lewis and Peter Jones. And so we now have the relevant legislation and the special new tax reliefs which the Chancellor has brought in, which is designed to encourage and promote, as I say, what he called indirect employee ownership. The reliefs are quite interesting. They cover capital gains tax, income tax and inheritance tax, and we'll deal with them in that order. The capital gains tax relief is spelled out in the first 4 paragraphs, paras 1 to 4, of Schedule 37 Finance Act 2014. And what they do is they provide a capital gains tax exemption on the disposal of ordinary shares in a trading company to a trust that satisfies the all-employee benefit requirement that is spelled out in this new legislation. So in other words, in order for the trust to be a qualifying employee ownership trust, it must broadly operate for the benefit of all members of staff. And the way the capital gains tax break works is that when our client disposes of ordinary shares in a trading company to such a trust, it is treated as an automatic no gain, no loss transaction, just like transactions between husbands and wives, or alternatively between companies which are part of the same 75% group. Now, the interesting thing I think about that is that when these proposals were originally announced, I assumed they would only apply to philanthropic clients, perhaps who hadn't got children and therefore couldn't leave the family business down a generation, who had decided to leave it to their staff and had as a result set up one of these trusts, and perhaps either on retirement or on death were transferring their shares to the employee ownership trust. But the legislation interestingly talks about a disposal, and a disposal obviously could be a sale, I guess, as well as a gift. Does that therefore mean that obviously the trustees have got to be financed elsewhere, but does it therefore mean that I could sell my shares to a qualifying employee ownership trust, and instead of paying, as it normally would be, 10% capital gains tax, I pay nothing because it is a no gain, no loss arrangement? I haven't seen so far anything that will preclude that. The new legislation for the capital gains tax exemption came into force on the 6th of April 2014, so that legislation for disposals made on or after that date, so that legislation is already up and running. The key requirement is that there has got to be a disposal of a controlling interest to a qualifying trust. But the rules say that the trustees only have to hold a controlling interest in the company at the end of the tax year for which the capital gains tax relief is claimed. So if, for example, the trustees have already got 31%, and if I give or sell them 20%, although I'm not disposing of a controlling interest, can you see at the end of the relevant tax year the trustees will have a controlling interest, because the 20 will be added to the existing 31 and take them over the magic 50% barrier, and so we will have satisfied that constraint. It is, of course, a requirement, as you might imagine, that the trustees have got to be able to apply the trust property for the benefit of all the eligible employees of the company, but we've already touched on that. If you want to look at the all-employee benefit requirement, you need to have a look at section 236J, TCGA 1992, which is one of the new provisions that's been inserted in the Chargeable Gains Act by Finance Act 2014. So that's the capital gains tax break. What about income tax? Well, the next 4 paragraphs of Schedule 37, so that's paras 5 to 8, Schedule 37 Finance Act 2014, introduce the employment income exemption. And what that basically says is that any bonus payment, provided it's paid after the end of September 2014, so in other words, on or after the 1st of October 2014, so notice that's not 6th of April, it's 1st of October 2014, this particular arrangement starts, any bonus payment paid to employees of companies controlled by an employee ownership trust will be exempt from income tax up to a maximum of £3,600 per annum. Notice that in order to qualify for your income tax exemption, the payment must be an award other than your normal salary or wage. And of course there is some quite detailed legislation designed to ensure that you don't try and circumvent that, as you can imagine. The legislation says the award must be paid to all employees on equal terms, but it doesn't of course mean that the bonus payment has to be identical for every member of staff. You may have been in the firm for 10 years, I may have been in the firm for 5 years, you get £1,000, I would therefore perhaps only get £500, because the legislation says the length of the employee service may be one of the varying factors. Similarly, the level of salary. You might be on a salary of £40,000, I might be on a salary of £15,000. So if your bonus is 400, my bonus presumably would be 150 in those circumstances. So there is provision in the legislation for the bonus to be flexed for a variety of reasons, but as long as it is a genuine bonus and not part of your normal monthly or weekly salary or wage, then in those circumstances up to a maximum of £3,600 per tax year will be completely free of income tax. And as I say, that came into force, or comes into force rather, for qualifying payments made on or after the 1st of October 2014. The final exemption, which takes up most of the rest of Schedule 37, amends the inheritance tax rules. Like capital gains tax, the inheritance tax change bites from the 6th of April 2014, so at the start of the present tax year. What it says is that transfers to an employee ownership trust are exempt from inheritance tax if that wouldn't anyway be the case. In my experience, if you had set up what we now call a qualifying employee ownership trust, it's fair to say that most transfers into such a trust would normally already, under existing legislation, be exempt. So I think the IHT rule is really covering things. Just in case a situation arose where it wouldn't qualify for IHT relief under the existing legislation, the new Finance Act 2014 provisions says it will still be exempt from inheritance tax. So any transfer, whether it's of cash presumably or shares or any other asset, to a qualifying employee ownership trust will be exempt from inheritance tax. That means it won't be a PET, it won't be a potentially exempt transfer with a 7-year run-off period, it'll be exempt ab initio. What is more, the legislation also makes clear that even though it wouldn't otherwise be the case, the trust itself will also be an IHT-free zone. Again, normally you'd probably expect that to be the case, but even if it wouldn't be, the latest legislation makes it clear that the trust itself will be IHT free. So if for whatever reason capital was distributed out of the trust to one or more members of staff, then that would not be treated, for instance, as a taxable exit charge. It would be IHT free. And as I said, the starting date for those inheritance tax rules, like the capital gains tax break, is the 6th of April 2014. It's an interesting idea. As I said, it's popularly referred to as a sort of John Lewis model. It doesn't, I have to say, exactly parallel, as I understand it, the way employees in the John Lewis empire are remunerated, but I suppose it's a reasonably close approximation to it. And it's certainly an interesting innovation, which I imagine will be particularly taken up by philanthropic shareholder directors who don't have children or grandchildren to whom they can leave their business, and if they wish to leave their business to their staff rather than selling up, then in those circumstances these measures will be useful ones to follow. Thank you for listening to this talk. My name is Robert Jamieson.